Okay, good evening, everybody. It's 5:33, so we thought we would start. Thank you, everyone, for joining our virtual town hall. This event is sponsored by Senator Sharon Moriwaki, Representative Scott Nishimoto, Representative Adrian Tam, and myself, Representative Scott Seki. We wanted to hold this town hall to discuss a growing topic that is causing uncertainty for residents, and that is the rising cost and availability of condo insurance. Some of you may have joined us at McKinley High School in March to discuss this topic. We thought we'd follow the same format tonight by hearing from an expert panel and then answering residents' pre-submitted questions. Unlike the McKinley discussion, we wanted to spend extra time today explaining how we can potentially mitigate the impact of this issue. So before we hear from our panel, I'd like to ask our legislators to please introduce themselves. So Senator Moriwaki.
Thank you, Speaker. Aloha, everyone. I'm Sharon Moriwaki, Senator for Kaka'ako, Macaulay, and Waikiki. Glad you could make it. I'm glad to be here. Representative Nishimoto.
Aloha, I'm State Representative Scott Nishimoto. I represent the 23rd District, which is Macaulay, Mo'iliili area. Thank you to the panel for taking the time to do their presentations tonight. And thank you to all of you for joining us. Rep Tam?
Representative Adrian Tam is here, but he has, I think it's laryngitis, so he can't really speak right now. But welcome, Representative Tam, and thank you for co-sponsoring this event with us. He represents the Waikiki House District. So we have 4 topics that we wanted to discuss tonight. We have a slide to just explain what those 4 topics are. Basically, the questions are, these are the 4 questions. Why are insurance costs rising? What are the financial impacts? What are the potential solutions? And what has been done already to the current time? So our first panelist is Alex McLaury. Alex is an independent agent at ACW Group, which specializes in condominium and contractors risk solutions. He also has a biomedical background, so it's a very interesting combination. But we asked Alex if he could present on the first topic, why are insurance costs rising? Alex.
Thank you, Speaker Seki. Thanks for having me tonight. Appreciate the opportunity to come speak on this important topic. I'll share my screen here. Right. Get right into it. Like Speaker Seki said, my name is Alex McLaury. I'm with ACW Group Insurance. I'm going to talk a little bit about the catastrophic losses and hard market, and the impact that we're seeing on the property premiums in the state of Hawaii and in general across the market in the U.S. So first slide. If there's the one thing that insurance carriers they tend to note within the insurance world is there's a definition for a natural disaster. The natural disaster is typically defined as a single event causing $25 million worth of damage, causing over 2,000 claims or buildings damaged, typically either 10 fatalities or 50 individuals injured in a single event. When we think of natural disasters, they tend to fall in line with a hurricane, wildfire events, the deep freeze down in Texas, hailstorms, droughts, any large-scale event that's affecting a lot of people. So that's over the last 3 years, we've seen an uptick in the natural disasters, which I'll kind of note in a few slides, that we've had a significant increase in these natural disasters. Actually, within 2023, we actually had the most recorded, I believe it was 28. So we've had a significant uptick in these natural disasters, which are touching not only our insurance carriers locally, but the reinsurance carriers abroad, which I'll get into a bit more on that. Then obviously with the the tragic event last August with Lahaina that kind of put us on the map for now what is the insurance term of a natural disaster here at home. So the second thing that's also contributing to a premium increase are economic factors. So as prices for goods and services are increasing, we're not only having an increase on natural disasters or catastrophic disasters, but we're also having just the smaller claims that are occurring, a water leak or a small fire. To actually repair or replace those specific smaller claims, the price for that is increasing, which is subsequently increasing the premiums to offset those costs as well. So kind of wrapping both of those together in terms of market dynamics, what does that mean and how is it really affecting? So local insurance companies, we have three that basically cover most of the associations here in Hawaii. Those three insurance carriers all purchase what's called reinsurance, and that reinsurance is the insurance for insurance carriers. And that same reinsurance is not only purchased by our three local carriers, but it's also purchased by carriers in California, carriers down in Texas and Florida, all across the US and around the world. About 20 of the top reinsurance carriers actually cover about 80% of the total insurance. So if something happens here locally, it's contributing to policies across the US and around the world, and vice versa. If it's happening down in Florida, it's also affecting the carriers' rates that they're paying for that reinsurance. So I mentioned at the beginning, what is a hard market? So kind of defining what a hard market is, there's a few variables that we see tend to creep up within a hard market. Obviously, everyone is seeing the impact of the increased premiums. Like I said, this is to cover the reinsurance costs that the insurance carriers are also having to pay, and then that is subsequently being trickled down onto the policyholders itself. The second is stricter underwriting, excuse me. That could be whether an insurance carrier is changing the appetite on, say, if it's a sprinklered versus a non-sprinklered buildings that have hurricane clips, the age of the building, the claims history of the building, those all are taken into account. In a hard market, they're going to be looking for something very specific within their appetite. Otherwise, they won't consider writing it. Additional characteristic of a hard market, reduced capacity. We're definitely seeing this as well. Carriers are looking at the aggregate on their book or the exposure on their book, and if it's too high, they're going to start non-renewing. We've seen that happen with sublimits for hurricanes being implemented, carriers getting off of particular risks, just limiting the exposure that they have on their book. Additionally, we're seeing more deductible or higher deductibles being placed, or if not higher deductibles, they're placing per unit deductibles. Those are relatively new and more common within a hard market itself. And then limited availability of coverage. So there's certain instances where it's going to be a stretch of maybe not only one carrier, two carriers, 10 carriers, 20 carriers. It might be 60 carriers to fully insure a association. So it's the availability that was maybe 5 years ago is no longer here, and it's taking a slew of carriers to come up with the coverage that is needed. So as I kind of spoke at the beginning, what is a catastrophic loss and how is it contributing to a hard market? If we kind of break it into numbers and just looking at the general trends over the last 10 years, since 2014, from 2014 to 2024, between 2014 and 2020, there was only 1 year that was over $100 billion in loss. And if you hold that, the average between 2014 to 2020 was about 44 billion. And then as this slide notes, from 2020 to 2023, we had 4 consecutive years over 100 billion in losses. So we've had consecutive losses over excessive amounts continuously, which is pushing our reinsurers to increase their rates for our local carriers. And like I said, this is the US reinsurance market. And as I mentioned, about 28 natural disasters over $1 billion last year, just within the US alone. So that's trickling down onto number 2, reinsurance market tightening. Reinsurers are also doing all the same things that those range or those local carriers are doing. So they're looking at their underwriting, who they're taking, and what type of buildings they're taking, and increasing their rates as well for particular types of risk. And then finally, looking at risk perception. So I think Lahaina is an example of where we weren't seeing reinsurers pricing for any type of wildfire exposure. Now, with an event that is on the quote unquote map for catastrophic event, we're seeing underwriting indicate that wildfire is an exposure that these carriers are starting to write for. And additionally, regulatory change. I think Commissioner Ito will probably get into it a bit more, but a lot of these carriers are considered they're considered non-admitted or excess and surplus lines carriers. So they don't have actual legislation here locally. They have legislation wherever they're domiciled, whether that be in other parts of the US or abroad, in London or Bermuda. So the impact on the legislation locally on their particular jurisdiction could also impact rates. And finally, what are the unit owners and associations feeling? Obviously, the financial strain, the costs of some of these policies are increasing 2x to 10x in some cases. So it's a considerable financial strain on a lot of these AOAOs. And then additionally, there's larger deductibles being placed on the associations. You're having water deductibles that are being kicked from a $25,000 to $100,000. I think the highest one I've seen so far is a $500,000 deductible. Or they're also doing we're seeing per unit deductibles. These are all effects of a hard market, and additionally, just the difficulty in attaining or renewing an insurance policy. As we kind of move into summer, we've seen one of the carriers start to reduce their capacity within frame, and that's really putting a strain on a lot of our associations that are outside of the Waikiki, more Mililani and Eva Beach area, and seen very, very large increases to those associations. So it's yeah, all three factors are major effects that the association and specific unit owners are feeling. All right, thank you very much.
Okay, thank you very much, Alex, for your presentation. Our second presenter is Victor Brock, and Victor will be speaking on the topic, what are the financial impacts for residents and buildings? Victor is the secretary and legislative co-chair of the Mortgage Bankers Association of Hawaii. Victor.
Thank you, Speaker Psyche. Good evening, everyone. And I appreciate the opportunity to present on behalf of the Mortgage Bankers Association of Hawaii. And Alex, thank you for doing such a thorough job in explaining the situation and the increasing costs of insurance. So I'm going to explain the impact to the lending business and how that impacts individual unit owners who may be considering selling their unit or refinancing or trying to get equity in the form of a home equity line of credit or a loan. And so let me try to share my screen here. So again, my name is Victor Brock on behalf of the Mortgage Bankers Association of Hawaii. And oh, there we skipped a couple screens already. So I'm going to talk about and explain Fannie Mae and Freddie Mac and their requirements and why they affect individual homeowners, what the difference between Fannie Mae, Freddie Mac type loans and portfolio loans are, what we're seeing as lenders in the mortgage business, and how the what's going on in the insurance business is impacting and concerning to lenders, both on the mortgage lending side and the commercial lending side. When I talk about commercial lending, it's when the association itself wants to approach a financial institution and get a loan for capital improvements, that's what I mean by commercial lending. Mortgage lending is when an individual unit owner wants to refinance or purchase a unit in one of the buildings that have the insurance issues, or when someone wants to get home equity financing on an individual unit. And then I'll go through some bottom line impacts to the unit owners or potential buyers. So first of all, I want to clarify Fannie Mae and Freddie Mac, who are these people? Well, they're not people, they're government-sponsored entities who purchase loans, mortgage loans from front-end lenders that make mortgages. So they stand ready to buy and provide liquidity to mortgage lenders in the United States. And then there's also FHA, Federal Housing Administration, and Veterans Administration loan guarantees. So all of these government entities or pseudo-government entities, they provide the most affordable, lowest interest rate, low down payment financing. Those programs are designed for first-time home buyers. They're lower interest rates. These government entities and pseudo-government entities are willing to take on risks that direct lenders are not willing to. But they do require that the condominium building have 100% replacement cost insurance. So that means that the insurance for fire or destruction or damage to the building cover 100% of the amount to rebuild the entire building. It does not include the value of the land, but it's an estimate of what it would cost to rebuild the building. And all of those programs and guarantee entities and agencies also require 100% of the value of the condominium building to be insured in case there's a hurricane that comes through and causes destruction. They allow a deductible up to 5% of the value of the building on any one policy. So most lenders, there's some lenders such as mortgage brokers or independent mortgage banks that do not accept deposits in the form of checking accounts and savings accounts. And those lenders are considered non-portfolio lenders. They have no choice but to sell those loans to other entities that will require that type of insurance, 100% coverage for the hurricane and hazard insurance. Then there's other financial institutions that you can call portfolio lending institutions, and they accept deposits, banks, savings and loans, credit unions. They are government insured. Their deposits are government insured, but they have the ability, because they accept deposits, to hold some of the mortgages that they originate on their balance sheet in their portfolio. Some of them may be willing to lend on the condominium projects that do not have 100% insurance coverage, but they also have concerns about what if there is a hurricane that really comes through and damages these buildings, and there's not sufficient funds to rebuild the building, and that those units and those condo projects are the underlying security for our mortgages that we granted. And the regulators that ensure the deposits are not very enthused about financial institutions making a whole bunch of these loans on buildings that don't have 100% coverage. So there's pressure. If they're going to do these types of loans at all, they're going to limit their exposure to a certain number. They're typically going to charge higher interest rates because they're considered higher risk. And they are not going to be able to offer the most affordable interest rate and the least down payment, the 5% down payment, the 3% down payment, or the no down payment loans that you can get under VA loans, Veteran Administration. So the options for potential buyers of a unit in one of these condominium buildings are reduced. So I want to point out, here's what we're seeing when what's happening with a lot of these condo buildings. There's over 400 that we are aware of in the state of Hawaii that have what's called a sub-limit, or they have condominium insurance for less than 100% of the value to rebuild. We started seeing it last year that they were getting only 25 million, and now we see that it's even lower, only 10 million. So for example, you may have a building where the estimated cost to rebuild is 300 million or $350 million, and they only have $10 million in insurance coverage. Another thing we are seeing is that some condominium projects, because the cost of insurance has increased so much, as Alex described, they have decided that they are going to only insure for 10 million or 20 million, even though the value or the cost to rebuild that entire building is 80, 90, 100 million. So they only have $10 million in coverage. Both of these situations are caused by increased costs, limited availability that Alex described, and some of the condo association boards of directors have to make a decision. Do we pay those excessively high premium costs to insure the building at 100%, or do we make it more affordable for our unit owners and reduce the amount of hurricane coverage or hazard insurance coverage? And I will talk, so what I'm going to talk about is what are the ramifications? What happens if they do not purchase 100% coverage? Both of these will limit the availability of mortgages for unit owners in these buildings. Another thing we are seeing is that the condominium associations are increasing their insurance deductible on per event or per unit, as Alex mentioned. So what a lot of the associations are doing is they're requiring that the individual unit owners increase their what's called HO6, which is an individual condominium insurance policy, to cover the full amount of that per event deductible. And that's okay as long as those individual unit owners are able to get that individual HO6 policy. But now some insurers are limiting their exposure, and it's getting harder and harder for those individual unit owners to get that gap policy. That may also affect that unit owner's ability to refinance or to sell the unit, or any sales in a building where no one can get an HO6 policy in a building. And that's happening right now. And then when a condominium association decides that they're going to reduce their either hurricane or hazard insurance coverage to less than 100%, that will impact also the association's ability to secure a commercial loan to complete capital improvements, such as their piping project, or if they want to put sprinklers in, or if they have to do spalling, or if they have to do an elevator replacement or repair project. Without 100% insurance coverage, it's going to be very difficult for that building to obtain the commercial financing that they need. So the bottom line for unit owners is it may impact the ability of unit owners to sell, or severely limit the number of eligible buyers to cash buyers only, or only buyers that have large down payments, 20% or more, not 5% down, not 10% down. It may impact the ability of unit owners to refinance their mortgages, to get cash out refinances. And if they can find lenders who are willing to do those loans, the rates will typically be higher. And if someone wants to get a home equity line of credit, they may have a very difficult time finding a lender who's willing to lend on that building. Also, the impacts are that individual unit owners' costs for their individual their individual unit policy called HO6, they're having to get bigger policy dollar amount of coverage, and their expenses are going up. The premiums are going up on those types of policies also. And then, as I already mentioned, a shortfall of insurance will affect the association's ability to borrow money to do capital improvements. And ultimately, all of this may impact the value in the short run and possibly in the long run of the units in those individual condo projects.
Okay, thank you very much, Victor, for your presentation. Next,
you.
our next presenter is our State Insurance Commissioner, Gordon Ito. And we asked Gordon if he could discuss what are some of the potential solutions to this situation. So, Commissioner.
Thank you, Speaker Psyche. I'm going to share my screen in just a moment. Can you see the screen?
No, we can't see it,
Okay,
Commissioner.
I think it's coming up now. So,
Okay, we can see it now.
okay. So to follow what Alex and Victor had talked about, I wanted to start with this slide in terms of what's happening with the Hawaii condo master policy. As Alex had mentioned and Victor had mentioned, a lot of the distress that we're seeing in the condo market in particular is, due to the hard market, where condo associations are faced with the challenge of limited insurance offerings. So only, as mentioned, only a few authorized insurers are offering master policy in Hawaii for condominiums, and offering, as Victor pointed out, and as well as Alex, what's happening is that the three authorized insurers, some of them are putting out what they call sublimits. So Victor used an example of a building that replacement cost is $300 million, but I'll just use as an example a building replacement cost that's $100 million. And the sublimits, as Victor had noted, that it was started about May of last year, where one insurer was placing sublimits or limit on how much hurricane exposure they want to cover for that condominium building. So in a $100 million replacement building, that insurer was only willing to cover up to $25 million on the hurricane exposure. With respect to water loss and fire losses and liability, there is availability of coverage in the master policy for those risks, but it's the hurricane exposure that there's sublimits being placed on. So in the case where only 25 million of the hurricane exposure is covered by the authorized insurer, and an authorized insurer is one that meets the state solvency requirement. It meets the minimum capital and surplus requirements, and they're authorized to write business in Hawaii. The way the law works is if and only when there is no available authorized or insurance coverage offered by authorized insurers or admitted carriers in Hawaii, then insurance provided by surplus line or unauthorized companies are allowed to be written in Hawaii. And that's what's happening with the condo, because no authorized company wants to write the full hurricane exposure. Agents are forced to go into the surplus line or unauthorized companies to fill in the gap. In the example of the $100 million replacement condo building, if they only have coverage by an authorized insurer up to 25 million, they're forced to go and find another $75 million in coverage for the hurricane exposure, fund surplus lines or unauthorized companies. The unauthorized companies, unfortunately, we do not have any regulatory authority to regulate the rates that surplus lines insurers charge. And this is the thing that's driving the huge increases in many of the condominium master policy premiums. Because again, the insurance division does not have any authority over unauthorized surplus lines insurers and the rates that they're charging. We only have rate authority over authorized insurers, those insurers that are admitted to write in Hawaii. I'm going to skip through this slide on underinsurance because Alex had talked about this and the impact of being underinsured by the condo associations. And they're also gonna skip this slide with respect to condominium unit owners and the H06 policy. The H06 policy, what it is really the coverage provided within a unit in the condominium. Besides the condominiums and the impacts, single-family homes are also being impacted. In particular, on the homeowners side, that what we call HO3 policy or fire policy, the increases have been, about 20 or 30% in due to really replacement or reconstruction costs as well as the reinsurance costs. On the hurricane side, there's been significantly more a larger increases because of the cost and the rise in reinsurance that hurricane carriers are really purchasing and shifting some of their risk away. Things that condo owners can do, one of the most important thing is looking at mitigation. This slide is on more so on homeowners, single family homes, but with respect to condominiums, really encourage condo owners and condominium associations really to look at what kind of risks, what things they can do to mitigate risk within their building. Like one example is, I own a condo, an older condo, and I know years ago, my condo association had requested and actually paid for the installation of very thick water connection pipes to the washers in our unit. So things like that can be done to try to mitigate risks of loss. I'll talk about what happened this past legislative session. There were several bills introduced to address what's happening in particular with respect to the condominium increases and really the hardening of the Hawaii market. So there were numerous bills introduced. So one of the most important bill was House Bill 2686 and the companion 3234. Some of the provisions in that bill would have amended the policy limitation in the Hawaii Hurricane Relief Fund. And right now in the existing law, there's a $750,000 policy limit cap. So that, would not, by lifting or eliminating the $750,000 policy limit, that would have given the ability of the board of directors of the HHRF to have more flexibility and perhaps writing the hurricane exposure for some of the condominium master policies, and we'll leave it up to the board of directors. The other thing that House Bill 2686 was also going to do was doing a similar thing with respect to the Hawaii Property Insurance Association, which is another fund that provides for coverage on single-family homes. It started in providing coverage for lava zones 1 and 2, but it now writes statewide. And there is also policy limitations on that, and that was going to remove those caps, as well as create additional flexibility to offer commercial insurance, which is really the condominium master policies. Well, unfortunately, that bill did not pass the legislature, but the governor has called a working group. We are already started discussions among several members of the working group in terms of, despite the House Bill 2686 not passing, what kind of short-term immediate steps that we can do to address what's happening with the condominium association master policies and especially the hurricane exposure. Also, the governor, as well as speaker and Senate president, have submitted nominees for the HHRF, and we're working on reactivating, well, I'll take that back, not reactive, but actually reestablishing the board of directors, and they can start taking a look at whether the HHRF should be reactivated and what kind of potential steps can be done to help mitigate or reduce the impact that condominium associations are feeling right now. So that's kind of what's happening at this very moment.
Okay, thank you very much, Commissioner, for your presentation. Our final presenter is will be speaking on the topic what has been done, and we were asked if she could just discuss a couple of initiatives that have been recently approved. So our presenter is Gwen Yamamoto Lau, and Gwen is the Executive Director of the Hawaii Green Infrastructure Authority, which is an agency under the Department of Business and Economic Development. So Gwen.
Thank you so much, Speaker, and give me a minute to share my screen. All righty. Mahalo again, Speaker and Senator and representatives, for this timely opportunity to share resources for condominiums. This is a really heavy subject, and thank you, the audience, for bearing with us. I know it's a lot of information. As Speaker mentioned, the Hawaii Green Infrastructure Authority, also known as Hawaii's Green Bank, was constituted in 2014 to provide inclusive financing to underserved ratepayers unable to get financing at reasonable rates and terms. Since we've expanded our programs to include the federally funded State Small Business Credit Initiative to bridge access to capital gap for small businesses and nonprofits statewide. And on May 30th, 2 bills were signed into law for HGIA to administer the CPACER financing and solar hui investment programs. CPACER which stands for Commercial Property Assessed Clean Energy and Resiliency, provides a non-traditional financing option for commercial properties, including multifamily projects, agricultural properties, and condominium associations. Instead of a mortgage, CPACER financing is secured by a voluntary government lien and assessment. Because this financing mitigates lender risk, I know Victor and others talked about risk, but because it mitigates lender risk, it allows lenders to extend the loan term to the life of the system of the equipment being financed. So CPACER does not finance everything. We only finance qualifying improvements such as solar PV, EV charging stations, water conservation measures, and resiliency measures like fire suppression systems, hurricane windows, and other retrofits that are fixed to and harden a building. However, a couple of weeks ago, I had a conversation with a board president, and he asked if we could finance their fire suppression system, which I said, yes, we can. He also said, hey, you know, Gwen, we need to replace the elevators, and asked if this could be financed. So as we were chatting about this, we weren't sure if elevators could qualify as an energy efficiency project. Fortunately, though, the statute allows for HGIA's board to approve additional qualifying improvements. So to make it easier as a one-stop financing option, I will be asking my board to expand qualifying improvements to all retrofits and upgrades needed for condominiums during our board meeting next month. So as mentioned, the way CPACER unlocks capital is through a voluntary government lien. This slide shows the triangle of risk. So the lowest risk is at the very top of the triangle. Property taxes are on the top, followed by the CPACER lien, then the first mortgage, the second mortgage, and the equipment loan. As you go down the triangle, the risk gets higher. When the risk gets higher, the interest rates go up and the term gets shorter. Because of our lien position, lender consent is required if you have an existing mortgage, but this allows CPACE lenders to stretch out the term of the useful life of the over the useful life of the equipment being financed. You know, last month we received notice from our property manager letting us know that one of our condos will be upgrading a drain, waste, and vent pipe replacement project, which is estimated to cost $17 million. This project has been well underway, and they've negotiated financing with a local bank, which is good, with a 20-year term and an interest rate that has reprices every so many years. But as an example, if this project could be repaid over the 40-year life of the equipment being installed or financed instead of a 20-year term, it could bring down the monthly payments a little more and to make it a little bit more affordable to unit owners. We have been working with Ernie Lau and his team at the Board of Water Supply as well as Hawaii Energy, and we encourage associations to consider bundling necessary projects such as repiping, fire suppression systems with energy savings and water conservation measures to lower your electric and water bills to help offset the other costs. I got an email from a property manager 2 days ago, and they are looking at doing fire suppression systems, and they have to repipe. So, if they could do efficient toilets, they're also looking at re-roofing, and with that, installing solar PV and also a solar carport to help lower their energy costs. Switching gears a little bit. Oh, one more thing. We are looking to launch the CPACER program next month. So more information will be available next month. Switching gears, up until now, condominium owners were locked out of solars because you don't own your roofs. However, the Solar Hui Investment Fund will provide condominium owners a vehicle to participate in clean energy by co-investing in a fund that installs solar systems on Alep's rooftops. This is a win-win program which will enable condominium owners to benefit from the state and federal solar tax credits and energy services agreement revenues, while the low and moderate income household will benefit from lower electric utility bills. We are looking to launch this program later next year. This slide, which will be made available by Speaker Saiki's office, has our contact information. Thank you.
Okay, thank you very much, Gwen. Before we get to Q&A, could I just highlight a couple of points about the two initiatives that Gwen just mentioned? Because the legislature worked really, really hard over the last 4 months to approve both of these programs, the CPACER program and the Solar Hui program. Those programs are intended to provide condo owners in particular with the ability to make improvements in their buildings, and to also do so with really low financial risk and lower financial cost. And for the CPACER program, we really encourage condos to look at this program, because there are two immediate benefits from this. The first is that if you finance your project through the CPACER program, you will avoid large front-end assessments on unit owners. And that's because the system is basically a pay-as-you-go system over the life of the improvement. The second benefit of the CPACER program is the fact that the loan is repaid by the individual unit owners in the condo building. If a unit owner sells his or her unit and moves, the new owner then takes over the obligation for that monthly payment. So it's a pay-as-you-go system that is assessed on the current unit owners. So these are really, this gives a total advantage to condo buildings that are in need of these kinds of repairs. So thank you again to all of the presenters for your presentations and for the information. We wanted to go to Q&A now. Thank you to all of the residents who pre-submitted questions for this portion. We did kind of try to group the questions together. Some of them may have already been answered during the presentation, so we may skip over those questions. But we'll try to do speed answering so that we can get through all of the questions this evening. To kick it off, I wanted to just ask, I think was an important question to our panelists, which is basically, and a couple of you have touched on this, but what do condo association boards and unit owners need to do at this point going forward to mitigate risk in their buildings and in their units? And you can just jump in, panelists, please jump in for this portion. So first, for the condo associations, what are some of the tips that you would have for the associations, for the boards?
Hi, Speaker Saiki. I can jump in a little bit on this question. One big thing that insurance carriers are looking for is just risk mitigation, especially with repeat claims. Obviously, water claims have been a huge issue for a lot of high-rise associations. So any type of mitigating those repeat instances, whether it be through older pipes that need replacing or just doing a high-risk component inspection, looking at more of the wear and tear items under the sink, the refrigerator, behind the toilet, those type of items that have a little bit quicker life cycle. Tackling those and making sure that those are in good operating order and well maintained are going to be something that will help your claims history and then move you towards the top of the associations going out to market. So that'd be one recommendation.
Okay. Are there other recommendations from the panelists for boards, association boards? Any recommendations? Okay, what about recommendations for individual unit owners? For individual unit owners, any recommendations? Commissioner Ito?
Yeah, Speaker, I kind of touched on it in terms of, and Alex just talked about it, but within the unit, again, what can be done, check your pipes, the water connections, making sure, if they're old, you really encourage you to replace it. But collectively, I mean, a lot of times you have to require water shut off for the entire building, and so the association should get involved with that. There's other devices like leak detection devices that could be possibly installed, and so it's like think about what kind of mitigation things can be done, within the unit that would prevent loss. So.
Okay, thanks, Gwen.
Yeah, if I could just jump in, get up to speed with what the insurance coverage your condo has, attend your board meetings, be proactive that way. And, if there is a special session or if this insurance bill comes back to the legislature next year, please testify. Speaker and our policymakers worked really hard to try to get it over the finish line, but it really needs your voices also. So I encourage you to do that.
Are there any other recommendations for unit owners? If not, let's go to some of the questions that were pre-submitted, and I'll just kick off the first question, which is why do condo associations require individual owners to carry homeowner insurance policies in addition to what the association's master policy covers? Is this required by law, or is it something that's done on a condo by condo basis? So I think, Alex, you want to cover that question?
Yes, I can definitely address that. So within the state legislation 514B -143, that's you're going to be your blueprints for associations to go off of for what the insurance requirements the association needs, and also for unit owners. At the very beginning, that law indicates your bylaws and declarations are going to be what drives the actual policies that the association has to follow. But within 514 itself, it does have the ability to, if by, I believe it's majority unit owner vote, you have the ability to force place HO6 coverage onto the unit owners. So yes, it is by law, but it is case by case. It has to be approved by the association with a majority vote.
Okay. Thanks, Alex. Senator Moriwaki, do you want to start with a question? Oh yeah. We can't hear.
These questions have to do with the current situation with insurance. And maybe the commissioner already answered this question, but are insurance companies currently exiting the Hawaii market?
No, there's Senator. Fortunately, I haven't seen any wholesale exit of insurance carrier, and most of the carriers have indicated their commitment to the Hawaii market. But what's happening on a limited basis, as I think Alex talked about, and maybe Victor, carriers that are still in the market are reassessing the risk, and they are starting to look at areas that they deem higher risk and maybe non-renewing certain policies. But as a whole, not like what happened after Hurricane Iniki, where companies just totally exited the Hawaii market, and that was really what happened with hurricane coverage. There wasn't anybody that was offering to write hurricane coverage in Hawaii after Iniki, and we created the Hawaii Hurricane Relief Fund, which is the thing that we're discussing at this very moment, and reconstituting the board and possibly restarting the Hurricane Relief Fund to provide coverage for the condominium master policies, as opposed to having it be provided by the surplus lines not admitted market. So that's what's happening. But fortunately, most of the carriers are still committed to the market and haven't totally exited out.
That's good news, but they are, as you mentioned and Alex mentioned, the prices are going up for the insurance.
Yeah, and if in the worst case scenario they're not able to find coverage, they can look at the Hawaii HPIA, the Hawaii Property Insurance Association, which we had requested last year to plan on expanding capacity, and they are starting to pick up some homeowners policies, throughout the state. So there's that availability. The other thing I'd like to mention is that we have a rate comparison sheet for homeowners, condominium, and renters. They can look at the rates from various carriers. I would encourage, if they do get a non-renewal notice, that they really take a look at our rate comparison sheet that can be found on our website, which is cca.hawaii.gov/ins. And they can, get an idea of what carriers are still writing. Give them a call if they're willing to write their policy if they get a non-renewal notice. And they can also shop and compare rates between carriers.
Great, thank you. Rep. Nishimoto, do you want to ask the next question?
Okay, next submitted question. How is condo insurance rates determined? Are all insurances increasing? If so, how much of an increase are we expecting over the next few years? What are the future implications?
So, Representative, that's a good question. It depends on what kind of coverage we're talking about. So as I mentioned, on the single family home coverages, it's been increasing on average about 20 to 25%, nothing compared to what's happening, really in the condo area, which is really unfortunate. And within the condominiums and the master policy, it really what impacts rates, again, is really their loss history, type of construction, location. And so it really varies from condo to condo. I know in one of the other seminars I was participating, one agent had mentioned or answered a question about, I live next to a condo or a townhome complex, and what, the townhome complex next to us, might have had only, I wouldn't say only, but, saw a 100% increase, where my condo saw a 400% increase. And why is that? And that's really dependent on, type of construction, loss history. And the example the agent gave, you could have had two condos side by side, similar construction, but it was noted that one condo had, I think, 77 water claims. And that's why, that rate for that condo, even though it's similar construction and right next door, the rates is significantly higher. And just going back on authorized carriers, those three carriers that are writing the master policy, as well as the HO6. The HO6 policies are written by admitted and authorized companies, and what we do is those carriers are required to submit their loss history, their expenses, and we take a very hard look and only approve rates within what our statutory confines is rates can't be excessive, inadequate, or unfairly discriminatory. And so, our division, I think, has done a very good job in keeping rates unauthorized within a certain parameter. In fact, I'd like to note that, in 2011, the legislature, with our bill introduced, the bill I introduced, we actually got authority to go in and request homeowners or any insurer to refile rates if we thought the rates were excessive. And in fact, in 2011, we did that. And the end result was there was about $11 million a year saving. So on authorized companies, we have authority, but what's happening again with the condominium is the surplus line of unauthorized companies are writing that extra uninsured portion that's not covered by the authorized carriers. So we don't have, again, rate authority over any surplus lines carrier, and you know, the rates are, that's why the rates are going up significantly.
Okay, thanks, Commissioner. We're gonna do speed answers because we want to get through all of the questions this evening. So the next one is a kind of a condo specific question. I think when this condo was built, the developer used insufficient piping that were not to code, and resulting in leaks in different parts of the building. And an insurance agent said that the excessive claims in the building would cause the entire building to be blacklisted. Is that a likely scenario? I know this is a condo specific question that may be difficult to answer. Commissioner, do you have an opinion on this?
Yeah, I mean, you know, there may be some condominiums that insurers are reluctant to write, and that's where really the condos would be charged higher rates because of the loss history.
Okay, thank you. Senator Moriwaki.
Yeah, would properties, and maybe it's Alex, would properties with open rebuilding claims be treated differently in your in your coverage?
So thank you for the question. That specifically, I think what they're trying to get at is if there's buildings that were damaged, let's just say it's over in Lahaina, 4 buildings that were total loss, and there's 10 buildings total. Those 4 buildings, the replacement cost should be excluded from the total total policy limit. So say each building's $10 million, there's 10 buildings total. We have $100 million. At renewal, that policy would be likely written at a 60 million. So you'd have a reduction in the total amount. They're only going to cover the buildings that are in like operating order, and they're not having any construction that's currently ongoing. That'd be flipped to a different type of property policy called a builder's risk. So yes, it would be rated differently. Just it's only going to be rating on the buildings that are actually completed. Nothing that is going to be
buildings that have open claims like water leaks and so forth, that they have claims in the building itself. Would they be treated differently? Not so massive like Lahaina, but you know, in buildings.
Gotcha. Yeah. No, definitely. Also, very good question. I think Commissioner Ito definitely hit it right on the head. It's comes down to the total loss experience. So if there's one single open claim, that's not necessarily going to mean that this association is going to have a massive rate increase. But if you have a history of 5 claims, 10 claims a year, each of those claims are $50,000, $100,000 in water damage, then yes, that's definitely going to have a factor. So it's always a big picture. How is the building doing as a whole versus just if it's just a one-off event?
Rep Nishimoto.
Thank you, Rep Nishimoto. Oh, well, you have to turn on your mic.
Okay, sorry about that. The next 2 questions are pretty similar, so I think I'm going to combine them. Why are there not regulations that limit insurance companies' ability to raise premium rates astronomically? And is there a watchdog to ensure that insurance companies are not getting huge windfalls?
So Nishimoto, as I covered, for authorized insurers, we are allowed to review rates and approve rates. But it's the unauthorized or surplus lines carriers that we have no authority to regulate those rates that are being charged to the condo association.
Okay, thank you. The next question is Hawaii considering setting up a not-for-profit insurer like Florida? You know, I think I'll just take that question on because it is something that the task force that the governor created could consider, although there are differences between what is happening in Florida versus Hawaii. And, you know, the legislation that we did mention earlier that did not make it through the legislature did propose to provide some startup capital for 2 existing funds, the Hawaii Hurricane Relief Fund and the Hawaii Property Insurance Stabilization Fund. And the intent there was to provide some startup capital so that those funds could provide a layer of reinsurance for condo buildings and other residences. It was meant to provide a temporary stopgap layer of insurance so that condos will not have to go to the surplus lines or to the foreign sources for this kind of layer of insurance. It may have been expensive, but it would have been a local product that would have been made available. So the next question is, what's the status on the 3 bills introduced during this past session? I think we kind of answered that. It kind of relates to what I just mentioned on the Hurricane Relief Fund and the Property Insurance Association bill.
And I think the next question is similar too in terms of the relief fund. So next question is, why did the bill for condo owners to file complaints against board members die? What happened to the hurricane relief monies to bridge the shortfall insurance gaps that is now in the general fund? Do you remember that, with condo owners to file complaints against board members? I'm not sure whether that was an insurance bill or not.
Yeah, I guess we can cover the second question, which was what is the status of the Hawaii Hurricane Relief Fund, and can that be used to shortfall insurance gaps? So I think it goes kind of back to what we had mentioned earlier, that we wanted to use the Hurricane Relief Fund to help provide a layer of reinsurance for Hawaii condos. And that's a bill that we'll continue to work on through the governor's task force this summer. And incidentally, the governor has indicated publicly that, he is willing to call the legislature back into a special session to address this issue if we can identify some potential solutions.
Okay, the next question is, are the new laws applied differently to leased property as opposed to fee simple?
I don't think so.
Commissioner or Gwen?
Gwen?
And Commissioner, you can talk about the insurance side of it, but on the financing, leasehold property, ground leases are eligible. So if it's a space lease, not eligible, but on ground leases, it's eligible as long as the fee owner consents. Thanks.
Commissioner, did you want to add on to that question about lease versus fee simple properties?
Well, that lease versus fee, as far as insurance purposes, it doesn't have any impact.
Okay, I will take the next question, which is basically, what can the state and the federal government do to help residents in this situation? So I think we kind of did address what this, the state proposals are. As far as the federal government, we have informed our congressional delegation members of this situation. They are well aware of what is happening. I would want to emphasize that what is happening in Hawaii is a national issue. This is happening in other states throughout the United States. So it's not just Hawaii. This is a national issue. We have alerted our congressional delegation, so they are aware of this. We have asked them specifically to see if they can help mitigate some of the requirements that Fannie Mae and Freddie Mac are imposing on all of us. We haven't, they're still working on that specific issue.
This next question has to do with notice given by insurance companies. This person says they were barely given 30 days notice of 100% rate increase. A condo does not have the money to cover the increase. Can the state require insurance companies to give notice more in advance, perhaps a minimum of 6 months for rate increases, or to create a timetable based on percentage hike and minimum fair notice, Commissioner?
Yeah, so what's happened again, it's surplus lines carriers that are providing the upper layers for the hurricane exposure. Again, we don't have any authority over them. I know agents are scrambling. I think Alex had mentioned to cover that uninsured layer for hurricane exposure. They're scrambling around and putting multiple insurers, trying to get quotes from multiple insurers to cover up to the full replacement value. So what's happening is really the insurer, they're going out to, 50, 100 insurers asking if they would want to take a portion of the hurricane risk. And, oftentimes the acceptance or the quote coming back is just a few days before the expiration of the existing policy. And so they're scrambling around, and that's the end result. And again, it's coverage provided by unauthorized insurer, surplus lines insurer, that is not licensed in Hawaii to do business.
I can talk just a little bit about that, kind of why it's a lot of these surplus lines carriers are also giving their quotes out sometimes within a week, 2 weeks. I've seen come 3 or 4 days before renewal. As we've kind of all discussed throughout this panel tonight, this isn't only a Hawaii issue. This is a nationwide issue. So a lot of these carriers are getting hundreds, if not thousands, of submissions every single week to not only insure the properties here in Hawaii, but also in California, down in the Gulf Coast, in Florida. So they're inundated with a large exit of the admitted carrier space into the non-admitted carriers. So the just sheer amount of work that they're going through is kind of also a limiting factor for their ability to actually turn over those quotes. But try to push them as much as you can to get them as soon as possible. But I think it's on the onus of the agent to kind of have that communication with your associations, letting them know, hey, this is likely what's going to happen. We don't know where the specific rate is, but based on the market, this is where we're expecting it to be.
Okay, next question. Condos that are higher than 100 feet have fire sprinklers or must pass an evaluation because the ladders on fire trucks only extend to 100 feet. New fire trucks can reach 230 feet. Would a further reaching fire truck tame insurance costs?
I don't have the answer to that. I mean, it might have an impact on certain buildings, but as far as really the requirement on water sprinklers, that's not within our jurisdiction.
Speaker, you're on mute.
Mute.
I have a question. Would you suggest bringing all the grandfathered items that passed inspection up to code? So these are previously grandfathered features. I'm not sure if maybe Alex, I'm assuming that there should probably be annual inspections even for features that have been grandfathered.
Typically, I think the biggest thing that we see right now on the insurance side for high-rise properties is whether or not they have what they've done for their life safety evaluation, and if there is any potential action by the associations to install any of the recommendations within those life and safety evaluations. But as for the rest of it, I think it might be a little bit more case by case.
Okay, thank you.
This is for Gwen. Gwen, I know you covered the C-PACER program, but are there specific criteria for eligibility that you look for, and what's required for an association when they come forward?
Yeah, thank you, Senator. Yeah, so eligible commercial properties. So you need to put industrial, commercial, multifamily, or condominium association. But the other part of it is the lenders. So there are CPACE lenders, and they will do their due diligence like any other lender. So I will have them on our website. I'm hoping that our local banks become CPACE lenders too once they get comfortable with the program. But they will do their due diligence like a regular lender would.
So is there anything special that condos need to have of their condition or anything in terms of what you're required or the lender is required in these cases?
Right. So, they're going to the lenders are going to look at the financing like any other condominium or commercial property owner, right? One of the things that they may require, and again, it's lender by lender, right? As Victor mentioned, they may require full insurable value policies, right? Or others might be willing to take a little bit of a risk on that. They will do their due diligence and do the underwriting the way they do the underwriting.
And does the condo association, some percentage of that association needs to agree that they're going to go forward with this loan?
Right, right. So according to 514B, 50% of the owners need to vote yes on the financing. That we didn't change that. That's currently in the law, right? And I would encourage condominium associations to do their due diligence like they do with any other lender. Get a couple of quotes, proposals from regular financing and as well as CPACE financing and compare them. Thanks.
Thank you.
Okay, final question that was submitted. What resources are available to help Kupuna veterans and retirees on fixed income?
Mhm.
Maybe Victor might know.
Well, I don't know that there are special resources that are dedicated to kapunas that are having challenges specifically because insurance premiums have gone up or their homeowners association maintenance fees have gone up. Every lender wants to keep a homeowner in their home, and so they're going to do whatever they can do to help that payment challenged borrower, kapuna or otherwise, stay in their home. And that might mean doing a modification of the mortgage to stretch out the payment or lower the interest rate in certain cases. It depends. It's case by case and it's too hard to come up. But there's no dedicated resources just for folks who are challenged by increases in insurance premiums or increases in homeowners association maintenance fees because of increases in insurance. It's not that targeted or specific that I'm aware of.
Okay, thank you very much, Victor. So that was the last pre-submitted question. We can just go into brief closing remarks. Senator Moriwaki.
Yes, thank you. Thank you, Speaker, for organizing this, and thank you to the panelists. I've learned a lot tonight. We were in the other town hall previously, and tonight we even learned more about what's available. I do want to encourage all the condo owners to look at, as Gwen mentioned, look at what you have in your with your association, your board, and really look at your insurance policies and get more involved with your association and your board. Aloha, and thank you for joining us.
Nishimoto.
Yeah, I ditto to what Sharon said. Thanks so much to the presenters and for all of you for joining us and for Speaker Psyche for spearheading this town hall. Thank you.
And Representative Tam, thanks for joining, even though you are under the weather and have laryngitis and can't speak. So thank you, Representative Tam. And again, thank you to all the presenters for being here tonight. Thank you to the legislators also for co-sponsoring this event. We know this is a really concerning issue for residents, and I just want you to know that we are continuing to work on this issue over the summer. We'll be working with the governor and our colleagues in the legislature to see how we can address this. So again, thank you very much for attending this. This presentation will be available on our website, and I think we have a slide to give you the address for that. It'll be posted tomorrow, so please feel free to share that with others. And here it is. This is the YouTube page. So again, thank you very much, everyone, for joining us this evening. Thank you.